So with me this morning are three amazing lenders. Like I said, we have Jeff Bochsler with Guaranteed Rate, Steve Boelter with Draper and Kramer Mortgage, and Lori Murray with American Riviera Bank. Thank you guys so much for being here this morning and taking your time out of your morning to educate us. So we've got a couple questions already set up. Again, we would love your questions and interactions. Please use the reactions or put it in the chat. And let's start off with the first one. How have interest rates increases affected buyers in recent months? Do you expect these to continue? Lori, do you want to start first with that one?
Sure. Yeah, rates are going up. They've kind of started going up toward the end of the year, and right now there's kind of no end in sight. Starting a war doesn't really necessarily help help rates as people kind of flee to safety, and they see bonds as something that's safe. So whenever people are kind of putting their money into the bond market, it causes the bond yields to increase, especially right now. But we've been seeing this inflationary trend for, everyone's been expecting it. Big numbers came out today as far as the inflation numbers came out a lot higher than expected. We've seen gas prices increase, food prices increase, rents increase. So we're really seeing that translate now. It is coming into the mortgage market. Rates today, I think the bond market, the 10-year this morning is at 1.99, which is pretty high for us. We haven't seen levels this high in a while. Is it going to continue? Obviously, I think, we're definitely in a rising interest rate market, and people should be prepared for that. And it overall affects buyers, just an 1/8% supposedly an increase in interest rate. We've kind of all heard this over the years, causes a rippling effect as far as affordability in homes. So nationwide, it affects more than it actually does here in Santa Barbara. Just, as you guys see out in your contracts, there's, you're seeing mostly cash. We're the first time buyer market here in Santa Barbara makes it's a little bit tricky.
Yeah, no, I definitely understand that. Steve, you want to wrap up a little bit more on that? So just how have you seen it affect buyers? What kind of ripple effects are you seeing with the people that you're working with, and how are you kind of working along with those?
Yeah, there are a number of people that are right on the bubble as far as debt to income ratios. Those people are affected by this. Every 1/8 in rate definitely causes buying power to go down. So the first time buyers especially are being hurt by the rising interest rates. We're up seriously almost a point in rate since 6 months ago. And it hurts mostly the first time buyers. The people that have been in for a while, they tend to be able to weather the interest rate increases a little bit better. And it also just puts people on edge as far as actually buying a home. They're like, oh, I don't want to pay 4% for a rate anymore. Whereas 3 years ago, if you had 4%, you were dancing. So it definitely it's going to slow down the lower end of the market, but I think the upper end of the market's going to be fine.
Yeah, agreed. It's definitely a buyer's mentality a little bit there. Jeff, how are you working? How are you working with that, or do you have anything to add with that?
Yeah, a couple of things. I definitely go off of what Steve's saying, and like the people that are stretching it right now, these rate increases are really cutting them out. The reality for all of the realtors, though, is those don't tend to be the people that are getting their offers accepted. So home prices are not being affected at this time. I mean, you're having 5, 6, 7, 10 offers on a place, and you're cutting out 1 or 2 of those people because of the interest rates increasing. So impact is low right now. Things to think about, though, is for just overall numbers, a 1% increase in rates, like Steve mentioned, you're seeing a $550 monthly payment increase, which is about a 10% increase in people's monthly payments. It's real money. It does cause people to pause a little bit more, and leads me to just say to all of you, make sure those people that are hot to trot to get a place right now are checking in with their lender every couple weeks and just getting an update on monthly payment. So even if it were 2 weeks ago and you made an offer then, just say, hey, before we make this offer on Friday or Saturday, reach out to Steve, reach out to Lori, reach out to Jeff, and get a quick update on numbers, just to make sure there's no surprise coming out of the weekend when you get your offer accepted. And they're like, whoa, that's $200 more than I thought. That's making me question things. Yeah. Other than that, I think on the rate front, that's impacting people more than normal is the second home and investment property right now. The federal government had some extra increases to, on the conforming front, at least second homes and investment property. So you're seeing very high interest rates on that level. That is kind of creating more pause on second home and investment purchases than normal. So again, 30% of our market's all cash. So we're talking about the other 70%. And the big headline is just make sure they're checking in every couple of weeks, because of the war, you're seeing wild swings, like rates dropping 0.3%, then jumping up 0.3% 3 days later. And it's not, there's no consistency right now. So yeah, hopefully that's helpful to you all.
Yeah, definitely real variable. Steve, you guys seeing any inconsistency between housing prices now, again, as they continue, I think, to rise, and appraisals with this market? I mean, for a little while, a year ago, not very many bad, wrong appraisals or lower appraisals. Are you starting to see a little bit of that now, or is that they still kind of staying consistent? You're muted, Steve.
No, in the Santa Barbara area, appraisals so far in our office have come in dead on the purchase price. We've had no issues with that. North County, there's a lot of issues with appraisals coming in lower, higher. I'm not sure what's going on up there, but in Santa Barbara so far, we've been very solid, even though the housing price increases have been crazy, as everybody knows. But the appraisers have kept up with that, and we've had everything come in at purchase price so far.
That's good. Lori, would you say the same for you?
We've had a few instances where they've come in lower, but it was expected. The buyers expected it, the agents expected it. We all communicated ahead of the time, knowing that it was pretty unlikely that the appraisal was going to come in. Fortunately, in our case, the buyers had enough down that it didn't matter, and that they were willing to spend that money, even though they knew that the appraisal most likely would not come in. So it really, for us, it's just been communication, making sure everybody understands what it means if it does come in lower, how it affects their loan, how it could affect their loan. But we've had a few that have come in lower, but again, it wasn't, we weren't surprised, the borrowers weren't surprised, and the realtors weren't surprised. So again, I think because we were communicating, it made it okay.
Yeah, it makes sense. Jeff, anything to add to that?
Yeah, I'd say the same. The last year I had one purchase that came in low on the appraisal, and we all expected that. What I've been seeing outside the area is a lot of offers being with like an appraisal stopgap. So something that you're seeing where it's like, hey, it's a $1.2 million offer. We're willing to accept an appraisal that goes in $100,000 low. And we're still willing to make the purchase happen. So that might be something, if you're feeling sensitive about that, and or the listing agent is, that might be something to consider in the contract. But otherwise, I'm not seeing issues with appraisals right now. They're all sweating it. I've talked to appraisers, but they're somehow coming in at value. So might be good for having them on a panel. I'd love to hear more from them lately.
Yeah, Yeah, to that point, I think that's coming soon. We were just discussing that on, I believe, Education Committee. So that will be a good one. And love the advice on the, potentially a way to strengthen an offer outside of Santa Barbara County with the stopgap. Definitely would make your sellers feel a little bit more warm and fuzzy if you were able to say up front that you would be able to take care of some of that discrepancy there. So appreciate that. Steve or Laura, let's go back to you on timeframes right now. Obviously, with the market, we want to ride as hot as possible. I want to just drop a suitcase off of money for my sellers. What are you guys seeing for timeframes?
Yeah, I will say that we definitely have seen things kind of slow down a bit with rates coming up. So appraisers are turning appraisals around faster now. So which has been really helpful. We were at 1.3, about 3 weeks after appraisals. We're now about a week. So we are seeing turn times, turn times get a lot better for loans. Still dealing with TRID and all of what comes with that, and educating buyers as far as just staying on it and keeping that loan process moving along. We're able to get things closed fairly quickly. Everything is done internally in-house in Santa Barbara. So we're able to get things turned around, but we do warn that, hey, you're still relying on other people. You're still relying on inspections and appraisals and sellers. So just to keep everybody moving along has always been what we try to do.
Yep, absolutely. Jeff, you guys turned some things around.
Yeah, we're hitting 21 days pretty consistently when needed. I always just like to say everyone's hair is on fire usually at that time frame. It's possible, but it's not fun. Like Lori is saying, you're leaning on a lot of people and asking a lot of rush. We're doing the pre-underwrite to try to get ahead of that as much as we can, so the client's at least halfway down the field before getting into contract, which is helpful. Also seeing a lot of listing agents that like the short loan contingency release, but then are okay with 30 or 45 days on the close of escrow because their sellers want more time. So obviously something to talk about if you all haven't talked about, but 10 to 14 day loan contingency sign off because the appraisers are coming back quicker is doable right now. So
perfect. Steve, you want to chime in on that?
Sure. 6 months ago, we were lucky to get something done in 45 days. Like Jeff said, 21 days is usually very doable if you have a cooperative client and the appraiser gets out there right away. We always order the appraisal on day one. And we can work pretty quickly. It's pretty much having to rush every aspect of it, but we can get that done. 30 days is super easy. I still get realtors calling me, asking me, are we still at 45, 60 days? And I'm like, no, we're much faster than that. Very realistic to do 21 to 25 days these days.
Yeah, very good. Randy had a good question. I'll just ask it now because we're talking about timeframes. And this is a great question. On the new RPA, it does say that the loan approval, it's kind of like preempted that the loan approval is time period 17 days, used to be 21. Realistically, can you guys, is that a pretty much a good to go 17 days, or 21 is more? Should we start writing in 21 for you guys?
No, I think 17 should work in most cases. Again, a lot of it is up to our clients getting us paperwork and doing the TBD approvals. That helps tremendously, like Jeff was talking about. If we can get them basically approved except for the property ahead of time, no problem.
And Lori,
I agree.
Yeah, what percentage are getting TBD approvals? Like, are you seeing a lot of people go through that extra step process to be more competitive right now?
Yeah, we see a lot of it. We're really lucky in our marketplace. We're dealing with existing bank clients. So we have a relationship with them already, and we're able to turn pretty quickly for them and know how important it is to get things turned around for them. And in a lot of cases, we already have their financials, which is helpful. But a TBD is, we obviously prefer it. It makes our process a lot easier, and makes it a lot less painful for the borrower as well. So we want the loan process to be the last thing they have to worry about during this. We want them to be able to focus on the property that they're buying.
Yeah. Jeff, 17 days, good. And then your percentage of like TBD approvals. Why isn't everyone doing that also, by the way?
Yeah, it's, I'll take the second question first. The TBD approvals is just a challenge on the capacity front, because you have a lot of 21-day escrows going, and then you're asking your processing underwriting team to work on files that aren't even real. So it's a balance, right? So it's like, yeah, we want all of them to be that way, but you can't always fit them in time by the time they get into contract. And you're also kind of weighing out how serious that buyer is in the next 30, 60, 90 days, because you don't want to do this and then 6 months later have to do it again. So just know that, at least for us, that pre-underwrite could be done in a week, or it could be 3 weeks, depending on how busy things are for our team.
Yeah.
Other than that, yeah, 17 days isn't a problem. I mean, always extra days is nice, because it just leads to, if there is any surprise, you have time to work on it. But I think ultimately, everyone on this call that I'm seeing, you all do a really good job of communicating with each side and sharing that information, and everyone wants to see this to the finish line. So if 17 days isn't going to happen, people are going to speak up before that and share it. And that's so I don't see the 4 days right now, though. We all have a lot of capacity, because things have slowed down a bit, and underwriting's 1 day and processing can get through things quickly. So that could change, though, as we get deeper into the summer months. So check back on that.
Sounds good. While we're just finishing up on appraisers, there's a good question. It says, and this is a really interesting one. So, you have these appraisers coming in with these multiple offers over asking, and they're hitting the numbers on the appraisal, and then a comp comes up next to it, but they're not giving them that same like above value. What's your guys' thoughts on not giving that higher value, even though close comparables are closing high through that multiple offer situation? Have you guys seen any of that? Steve?
Yeah, not really. The appraisal process with the adjustments and everything, appraisers can kind of make the numbers work for whatever they need to hit.
Yeah.
And it seems like that has been not an issue that I've seen so far.
Very good.
I find that the misunderstanding oftentimes is, if the house is in contract but not closed, the appraiser can't technically use that other than use it for a compensating factor, but they can't use it as an actual comparable that they're going to use to make their number. And then a lot of people on the refinance front, you see this more of the complaint is, hey, the house down the street sold for X. Appraisers tend to be more conservative on refinances and purchases. They have a target number. Refinances, they're kind of in the dark a lot of times, and they're going to be more conservative. So it really depends on what we're talking about and what report and the reason for it, as to why that house down the street is getting credence or not. So, and time frame.
And it might be a good question for appraisal panel as well. But Jorge, if you want to unmute and just ask, maybe I didn't ask it correctly, or you want to add?
No, and thank you so much, Todd. That was actually closed very well. What I'm hearing is that they're using the word anomaly, for closing that close. This is a close comparable that closed within a quarter mile, very similar home, but somebody that used financing came in with the extra cash to close the gap between the appraisal and the contract, and they still closed the deal, but some appraisers are getting this information and saying, well, that was an anomaly because it was not finance. They actually came in and closed the gap. So that's the question that I'm having, is if you're seeing that for financed offers where the appraiser will say, you know, that closing down the street, it's not usual for this market. Yes, it closed higher, but it's, you know, let's say that it's 3 or 4% higher than what the average. That's the nature of the question.
Yeah, it maybe sounds like, to Steve's point, like those appraisals are just using their tools to get to wherever they need to get to with adjustments. Yeah. Anybody have any thoughts?
It sounds like a pretty unusual situation, just that one off, that since we've been all seeing values come in where expected, for the grand majority of it, that's probably a one-off situation.
Yeah.
But the underlier to the appraisers is they're still having to have consistent good appraisals, so they keep getting used by all of our companies. And so they can't stretch it to such an extreme and have wide variances without justification. So
yeah, makes sense. And we'll have them on again.
Just so everybody knows too, we as lenders, as loan officers anyway, are not allowed to have any contact with the appraisers. They're fully on their own. They're independent of, you know, we can't ask them for anything. We can't even know who they are. So, you know, they are pretty darn good. Like Jeff said, it's coming in on a purchase is pretty basic for them. Refis, they're definitely, like Jeff said, a little more in the dark, but it's a very independent process.
Yeah. Very good. So one more question, and then we'll go to our kind of crystal ball and look out in the future here and get your kind of thoughts on those. You know, one of you mentioned like second homes and investment properties here. I know a lot of the agents in town are working with clients, and a lot of the homes here are second homes or vacation homes. What are some of those options with rates rising, or just people using cash that used to just say, hey, I'm going to take advantage of these low rates and get this small loan on a multi-million-dollar vacation home? What are those rates looking like right now for investments, and what can be done kind of to educate those buyers? Because I know a lot of the agents on this call have those type of clients. And just jump in when you're ready, whoever.
I know for especially investment properties, the Fannie Freddie hits to the rate have gone up quite a bit, which is kind of driving us to do a little bit more of the out of the box loans, bank statement loans. We do debt service coverage loans where if the rents cover the mortgage, the PITI, the mortgage insurance, taxes and everything, then we can do a loan just based on that. So, and those rates are a little bit higher, but it's the whole lending world is opening up into the non-qualified mortgage world, where we're doing a lot more stuff that's a little out of the box. Just and in large part because Fannie Freddie did raise those rates for investment properties and second homes.
Lori, anything to add on that from your
end? We're still pricing our portfolio product pretty well for investment homes and for investment properties and second homes because of what Fannie has done. Because I think at some point they'll start dialing back when the demand comes down a little bit for primary. So so right now we're keeping our portfolio product competitive for that reason. And I do think that that these rates I think Fannie and Freddie will kind of back down on their increases that they've done for these products. But at the same time, they're under a mission right now to create more home ownership and primary home ownership. So that was the major force in why they made the move that they did. It's still, we still see a lot of that in Santa Barbara. And to Steve's point, there are a lot of different loan products out there and a lot of varying rates associated with them. So I always recommend people just to shop around a little bit, because those products vary quite a bit based on the market and based on what lenders have. And we always do stay pretty up to date as far as what our competitors offer, just because we know that we may not be competitive in some markets, but that we're competitive in other markets. So we really are looking out for the buyers to make sure they are getting a product that works for them and their intentions for the property.
Yeah, it makes sense. Jeff, how about you? And then just start to think, guys, the other side of the coin of that is we've been talking on the board about first-time home buyers in our market. It's really challenging. So maybe think on that while, Jeff, you're finishing up the investor conversation.
Yeah, going off what Lori's saying, that checking with a second lender, I think, is very helpful and smart right now. Just because all the lenders, because of these big swings the last couple of months, have been trying to find the right place for themselves. And just like things can, at a high level, things get really expensive really quickly for a lender if they have a bunch of loans locked in at a certain rate and rates kick up dramatically higher in a short period of time, that they're having to kind of counterbalance that with all the new locks. And so it all is to say, like, I've been doing price quotes and seeing wildly different rates out there of late that normally would be pretty consistent. So healthy to check that second source like Lori's talking about. And then in regards to just overall second home investment properties, 4.5% to 5% is what I'm seeing, and maybe Lori's got better, but that's what I'm seeing. And sometimes it's even coming with a point. So it's not all is to say, make sure they're checking rates before they get too excited, and make sure that payment works for them.
Yep, thanks, Jeff. So Lori, go back to you on the first-time home buyers. So again, challenging in our market. Anything that can help them that we can use as a resource when we're working with those first-time home buyer clients? Obviously, to Steve's point, there are a lot of people stretching right now or trying to like make that move, and then the rates are going up. But are there any first-time home buyer things out there that we can at least talk to them about? That's a carrot instead of
I know there's our first-time home buyers are so my heart breaks right now looking at it. Our median price is what, 1.3 million, 1.5 million. I don't know. Last year was 1.2. I'm sure it's even higher now. I think really there are some lower down payment loans out there, but they do come with reserve requirements, especially at the levels that we're seeing for first-time home buyers. I would love to see more, associations, condo associations get approved for conventional. It's been really tricky with the condo guidelines these days as far as requiring them to have kind of some structural stuff done to them as far as to sign up, for the HOAs. So I would say that for first-time buyers, it's tough. But again, there are some great lower down payment options out there. 3%, 5% is still available for first-time buyers. If they qualify income limit wise, there's still some great community home buyer programs out there. And there are some grants out there available as well. CalHAFA is coming back and made it a little bit easier to do those types of loans to get some down payment assistance. So, and I know employers are doing a lot these days to try to encourage their employees to stay in the area to help them buy homes. So we are seeing more activity that way for helping their employees with loans. And we will look at, you know, portfolio wise, you know, we are able to assist with employer sponsored seconds and that kind of thing that may not be available on the secondary market.
Thanks, Lauren. Steve, what about you for first time home buyers out there?
It's brutal. I just wrote 3 pre-approval letters for 3 different clients for the same property, and nobody got it. You know, it's something pops on the market under $1 million, so it has to be a condo right now, and you know, the overall payment with 20% down with the condo association fees, it was almost $5,000 a month. So in addition to the fact that there's no inventory, maybe 1 or 2 spots open up in the MLS, they're gone within a few days, over asking. So it's really tough for them. So, you know, with my clients anyway, we just keep trying. And yeah, there are a few down payment assistance programs, but it's pretty much just the people that we're working with, you just make offer after offer and just hope that somebody likes you. Yeah. So, but it's as far as, you know, the ability to qualify for a first-time home buyer versus somebody who's been in the program for a while, it's virtually the same. It's just tough out there right now.
Absolutely. Thanks, Steve. Jeff?
Yeah, I'd say we've got plenty of programs that are supportive of the first-time home buyer, like 10% down even on these higher purchase price. So you just need to make sure you've got the income to support those higher values, but it's just still hard to rise to the top when there's 5, 6, 7 offers and be the one that has 10% down or 15% down instead of 20, 30, 40%. So we try to shorten the time frames. We do the pre-underwrite and say, hey, though it's 10%, we've got enough comps here. We've got the pre-underwrite. We got a 21-day close. Like, what more do we want? So that's what we're doing to try to help to some success.
Yeah, appreciate it.
I do see a lot of that part of the market. Pretty much the way they're getting in is getting a gift from a parent. You know, they get $100,000 from their parent. Their offer stronger that way. That seems to be the most helpful aspect I've seen so far.
Yep.
Which has been Santa Barbara forever. I mean, I've been doing loans here for 30 years, and most people in Santa, at least, it hasn't changed much as far as how first-time buyers are qualifying in this town.
Yeah, absolutely. That makes a lot of sense. So for looking into the future, you guys can get your crystal balls out and say, you know, why don't you give us like kind of what you see at the end of the year, and then maybe what you see kind of in the next year or two. What should we be talking to our clients about now? Where do you think things are going to go? How can we educate our clients better with some kind of, you know, future visions from you guys? Anybody want to go first on that one? That's ready to rock.
I'll start since I got to start it all off in the beginning. So, yeah, my crystal ball says like go sit on a beach somewhere and drink pina coladas and just take a break. It's been a crazy market for the past 3 years, 4 years. I don't know. It hasn't slowed down at all for us. There was no pandemic break for any of us in this industry. But I think, you know, what's happening in the market, and you know, I think we knew what was happening with rising rates, and we expected rising rates, and we also expected rising home prices just purely due to lack of inventory. But the predictions are wildly varied between, you know, Fannie Mae, who expects, you know, an 11% increase in 2022, to the Mortgage Bankers Association, which is, you know, expecting a price stabilization at 0% increase this year. So I think that it's going to vary all over the map. What I think is going to happen, I think it's a reflection on how people feel. If you have a stock market that is continuing to be wildly crazy right now, people become less confident in the money that they have. So I think we will see a bit of a slowdown as far as appreciation. I think we'll probably we'll go through waves just like everything. We'll probably end up maybe, I don't know, slightly up over the beginning of the year, just because there's no inventory, which is the driver in this market right now, is just having nothing, and people needing homes and people wanting to be in our market. It's so desirable, as we saw during the pandemic, everybody wanting to move in. As far as rates go, even if rates hit 5%, it is what it is. That people are, I don't think it's going to affect that many. It'll affect as far as how much it's going to cost people on a monthly basis, but everything is costing everybody a lot more right now. And for their home, they're willing to do it if they can. If it makes sense and they can do it, they're going to do it. And as we see, rates come up and go down. The loan that they start out with doesn't have to be their loan for 30 years. What the average loan in California, I think, is kept for 4 years. So, it's just getting in and finding something a property that they want to be in for a few years. And as we always tell our people that this is your home. Obviously it's going to go up and it's going to go down. I think my first home, it took me 7 years to get back to where it was, where I paid for it. But that's the market, and be in it to, especially if it's your home, to be in it as a home, and as somewhere that you want to be. And it costs a lot of money, obviously, to buy and to sell. So, just kind of encourage people to be smart when they buy, and be in it, kind of for a period of time that they expect. And I will say, as far as I really do hope for everybody that we can, that rates don't go much above 5%. I think that really, I think will slow things down a lot more if they do go above 5.
Thanks, I appreciate your comments. Steve?
Yeah, our thoughts are basically rates are going to keep climbing for a little while. I know the Fed is talking about increasing rates throughout the rest of the year. Granted, our rates do not follow the Fed rate exactly. They trend a little bit that direction, but it's driven more by other factors. And then we are thinking that by November, December, we should be seeing a little bit of recession type stuff going on, which will drive rates down again a little bit. And like Lori said, just because we get you in a loan now doesn't mean you have to keep it forever. So we can always refinance and take advantage of lower interest rates in the future. And we have done that a lot, especially when we're doing the out of the box loans. Those do tend to be a higher rate. They're a little riskier. So we can always redo those in the future.
Perfect. Jeff, what are some of your thoughts here?
Yeah, going with Steve's comment about the Fed, the current prediction is 1.75% increase over the course of this year of their rate. They're currently at 0.25% federal funds rate, and so that would kick us up to 2-ish%. I think most of that, what we're seeing, has been priced into the market, and that's what Steve says. It doesn't directly impact us, but it does in the sense that it validates where the market's been predicting rates to be. So we're always kind of ahead of the curve. If they end up carrying out all 7 increases, you could probably see a 0.5% higher in rate than where we're at right now. That, impacts people maybe $50,000 on a buying level. So it doesn't change things too much. If you're buying a 1.2, now you can buy a 1.15. Doesn't impact things too much locally. Overall, though, inventory, you have to believe, is going to be extremely tight. And how that matters to all of us is a smaller pie, right? So as a realtor, expect less transactions overall, whether you have all cash or not. And so being more sophisticated about creating that funnel and getting new potential clients really bright. The big X factors though is what comes down to, for what Lori mentioned, is the stock market, I think, plays a big role in home prices here in town. I mean, if you have a $3 million stock portfolio and it drops 10% like it did the last month, I mean, you just lost $300,000. Yeah, you still have 2.7 million, but what's your sentiment about that? How are you feeling? Are you feeling as cowboy about, you know, just going and paying all cash for a 1.5 place for your kid? Probably not feeling as good about that. I mean, so that's one big thing. In the Russia-Ukraine crisis naturally is going to continue to play out, and could impact things on that stock market front. Other than that, I think the thing that we haven't talked about is the work from anywhere reality, and how much that impacts people being willing and able to come live in Santa Barbara. And if you start to see some major employers leading that charge of getting people back in the office, how much does that impact our overall price point, number of multiple offers, etc.? So if it's me as a realtor, finger on the pulse, care about rates, but those aren't going to be the major determinant, because again, the people that are bidding up these properties to the levels to get the offer accepted are usually not impacted by a $250 or $500 increase in payment on $1 million loan, for instance. But they are going to be more impacted on, can I work here while having my job in Chicago, and is my stock portfolio giving me a good feeling about what's going on in the world and the economy and spending this dollar amount. So hopefully that's helpful.
Yeah, definitely. Understanding their mentality is going to be is crucial in the next couple of years, I'm sure. So let's see, we got a question in the chat here from Melissa Kane. What trend are you guys seeing in refinances or new purchases? I guess refinancing versus new purchases. Anybody refining right now?
Yeah, refinances are down about 75% from a year ago. And that's all purely rate driven, but there are always going to be cash out for improvements. I have a client right now taking money out to help their kids buy a home. Other less nice things that happen that require money to come out of a place. So it's definitely down, but right now I'm probably 60-70% purchases, and the rest are refinances.
Yeah, Lori, you were saying something.
Yeah, we still have lots of refis in our pipeline, and it's mostly people just trying to take advantage of the equity that they've got over the past few years. So people always need cash, and they're kind of taking it out of their homes right now, especially while rates are attractive, if it's going to improve their situation a little bit. So we still are seeing quite a few refis, but we're not seeing as many of the the good conventional refis. Everything is tough right now. Loans are hard. We're in that cycle of the refinance market where all the good loans are done, and now we're just dealing with the hard ones. But that's okay. It's what we do. It's how we do it. And it's funny, when I got into lending, 30 years ago, I don't know. I think I started off as an intern doing real estate, and I saw kind of how real estate, and I'm like, well, people always need money, and that's kind of how I ended up in lending instead of real estate. But it's been quite a road, and people do always need money, so there will always be refinances for us. Obviously not at the levels that they were, but there's always a need for money, so there will always be that need for a refinance.
I can imagine a lot of people are interested in, like, hey, my house is worth 40% more than it was 2 years ago. I've got a lot of cash right now. I'm going to go buy another house with that. Yeah, Jeff, what are you seeing?
Yeah, that rebalance of their overall financial portfolio. It's some of the the wealthier clients are thinking that way. Other people are being surprised by just how much their remodel is going to cost.
Yeah.
And going, whoa, okay, I had budgeted 200,000, now I really need 400 or 500. So I can't just pay cash anymore for that remodel. And that's when they're reaching out. So a lot of cash out reasons, definitely right now, but overall, like Steve said, we're seeing a dramatic drop in number of transactions we have going on right now on the refinance front. So I mean, reality, money is still cheaper than what you could make over time in the stock market. So it's not a bad way to rebalance if you need to, or borrow. So
yeah. Randy, you got your hand up. Good morning.
Yeah, I just want to make two comments. Number one, just so you know, Gallup came out with a poll that said for the 8th year in a row that real estate has been the best investment for somebody. And when you think about it, and something we should explain to our buyers, one thing we're seeing right now is gas prices going up, food prices going up, obviously your property taxes going up. You know, I'm sitting at I have a large loan at 3.25%, which is your biggest investment. Your monthly payment stays the same on a fix. So if rates go up to 3.5, 4, whatever, and you do lock in, I think something we should at least let our buyers know is, at least you know your payment is going to be set. Things around you may go up, but at least you know that your monthly payment will always stay the same if you have a 30-year loan. And that's a nice thing to bring up, because everything is going up. At least I have the comfort of that, and which is obviously my loan's my biggest investment. So just a quick comment on that, just so you know.
Yeah, Randy, I love the insight there. It's definitely that's going to be a good feeling as things continue to rise, or they see all kind of like rising tides all around them. If they are purchasing now, at least they're kind of locked into what everyone is saying here is still a great rate. Any other comments to Randy's?
yeah, that payment with high inflation just gets cheaper every year. So hopefully your pay is going up too, and that's the big piece to it. So push on your employer.
All right, guys, we're 9:22. We nailed it. Gene, you want to do a final comment? What do you got? Good morning.
Well, good morning. So I think I may have bought about the same time Lori did. So I bought it in 2005, my little cottage, and self-talk was, Gene, you're a realtor. What are you doing buying at the height of the market, right? So that was 2005, and saw it all the way down through, but it's my home and I love it, and it's back up, and now it's over what I paid for it. So it's great that most of us do own a home, and we can share those stories with our buyers. It's the sense of place that people have found also so important these days.
Yeah, thank you, James. Great insight. I agree. Marcella, let's finish. Let's ask this question. So it says, do you have any loan products that allow buyers to make energy improvements like solar that fold into a mortgage payment, or make it easier for energy improvements? That's another topic that's going to be coming up from our education committee or MLS committee. Is solar starting to really kind of come back on the map here? Anything for that, guys?
The only thing I would suggest is do a home equity line of credit. You're not going to want to redo a loan to take cash out for something that's that relatively small. Yeah. But you can get a home equity line of credit. They're cheap. You only pay on what you use. If the solar company doesn't have their own financing, which I believe that's the best.
Had a lot of best. Yeah, the solar companies have some good financing out there. The clients that I have, I ask them to go, they come and ask about home equity lines for solar, and I send them back to their solar company. And then we compare it, and typically the solar companies have pretty strong products out there, just because the solar companies are getting incentive as well from the government to lend money for that. So I tend to send people back to the solar companies if they can.
Yeah, thanks for that, Jeff.
Yeah, excuse me, you got to make sure with those loans from the solar companies that there's a subordination clause. You get involved with a PACE loan or something, and they tie up your property, and then you want to go ahead and refinance, you can't do it. So.
That, you're right, unless if it's a PACE loan, no, I would
Right.
highly recommend against PACE loans. They're a disaster, but they've been a nightmare to deal with as far as trying to get them off of title. But if it's not a PACE loan, if it's like Tesla has their own financing, I mean, the larger companies have their own financing that's not PACE. So yeah, I guess you're right, Randy. I definitely do not want to get buyers into the PACE loans.
We do have on the purchase front, you can get slightly better pricing if you're buying something, home with solar. So something to think about and share with us at least through guaranteed rate. If you're buying a house with solar or your client is, let us know so we can make sure to include that in our pricing check. So.